The Managing Director and CEO of India's most valuable company, TCS, now joins me to help us understand what is the way forward for TCS. Chandra, thank you for joining us. Before we get into specifics, my compliments on what TCS has achieved. It's quite extraordinary. India's most valuable company in a leadership position. It's quite incredible what TCS has achieved in the last 5-7 years.
Thank you.
Let's get down into specifics. Now, everyone has deeply analyzed your Q4 numbers. We all know the pull pressures, the opportunities, and the challenges. What I want to understand from you is your commentary. You're confident that FY15 will be better than FY14. What is fueling this confidence? Better visibility, deep deal pipeline, big deals, more client spending?
I think the way to look at it is, let's look at what we have said over the last 6 months. We have basically given a few messages. We have said that the discretionary spend is picking momentum. We have said digital is a big opportunity. We have said India is soft, and it's going to be soft until the elections are over. And see what has happened. India has declined, and if you look at the international revenues for Q4 of this year, is pretty much same as the international revenues of Q4 of FY13. This year we did about little over 2%, and we did the same last year. Last year we had a huge growth in domestic business, India business in Q4, and that did not happen. So pretty much if you look at our Q4 performance, I think it is in line with what should happen from a seasonal Q4 perspective. The volume growth is pretty strong at 2.6%. And if you look at the 5 different factors I articulated, one is what our clients are saying. Our clients are saying that they're going to spend money in digital, in discretionary spend. We are getting a very positive commentary. Second, our deal wins and order book, I've said it's significantly higher than what it was the same time last year. Third, the pipeline that we are chasing is also significantly higher than what we were chasing the same time last year. Fourth, I definitely see a momentum in digital, and I am of the firm belief that it is a big opportunity based on all the data points and all the possibilities that I can envision. And the fifth is we are in a state of readiness for execution. It's very important whether we can execute or not. I think these 5 factors combined with what has happened in Q4. I look at what has happened in Q4 slightly differently. And I feel the momentum is strong. These are the basic factors. And people talk about pricing. Pricing has been pretty stable, and there is an odd quarter in which it drops. There's another quarter in which it goes up. If you look at the last 6-7 quarters, it has always been up and down. And overall for the year, we have had a positive impact on pricing realization, albeit very small. So given that, I think to go into FY15, saying that pricing is going to be stable, and these are the opportunities, and we feel good about where we are, and it's going to be a better year.
Now, if I will seek for a guidance number, you will not give me one, so I will not go there. So let me phrase my next question differently. When you started the year FY14, let's say on a scale of 1 to 5, if the business confidence was 4, is it at 4.5 for FY15? That number you can give me.
I don't know whether 4 out of 5 or whatever. I think the confidence is slightly better than last year because the momentum is there with more number of clients.
You know, in markets, it's absolute performance. Absolute performance is great. But then we always do a relative comparison. Given what is happening to the industry, what the peer set is doing, you're in a sweet spot. What's the secret sauce here? Market share gain, better delivery, better engagement?
See, I tend to look more at what we do. And if I tend to look at what we do, I think we've got 4 or 5 factors going well. One is our understanding for customers and what we do to be relevant with customers is getting better and better and better. Okay, year after year. I think we are in a much better position to be able to be of relevance to customers today than 5 years ago, 3 years ago.
So it is not just a market share.
Just a market share. So that's very important, and that's what is reflected in the customer metrics. Our customer metrics, if you see the last 5 year statistics, I think it's really telling. The second one, I think we have identified the opportunities and we are investing early. So if you take digital, it's just not enough to be able to capture the opportunity or be in front of a client because there is an opportunity. You need to have the whole engine ready to be able to take on and execute, whether it is talent, whether it is leadership, whether it is people with the right architecture skills, program management skills, front-end skills, or the tools that are required and the foundation software that are required. I think we have made those investments over the last 3 years, and more so in the last 2 years. And then we, I think, bring the best that TCS has to offer in terms of bringing the right domain expertise from a domain group, technology expertise, the project management expertise, and everything. How do you bring the best of TCS in front of the client every single time? And we're getting better at it, and this is again an area where you need to continue to keep improving, because an organization with 300,000 professionals has incredible strength. We've got a track record. We work with the best companies in the world. We have a lot of intellectual property, and you need to be able to articulate and bring the best talent and best thing that you got to offer, and we are able to do that better. I think these are the three things I would say.
India business. Now, the good news here is that India business for the quarter gone by has not contracted. But the bad news here is it is not expanding. When do you think it will start expanding?
See, we have basically said that at least till the election is over, and we have said a couple of times that we need to wait for the next 2 quarters. Until the September quarter, we shouldn't count. If we get some traction and we get an upside, that's a positive. Otherwise, I think we're not going to estimate that it's going to grow significantly.
So when you say that FY15 will be better than FY14, are you incorporating? So when you say that FY15 will be better than FY14, are you incorporating a flat outlook for India business, or that comment of yours incorporates a decent growth for the India business?
I think currently in the next 2 quarters, we are not expecting a big growth. If it is some slight uptick, but not significant. But we have not had a great growth last year as well. So,
but you prompted me for my next question, and I mean, I'm going to phrase this one very carefully. The case what you're making is that you expect FY15 to be a better year than FY14 at a time when India business is expected to be flat. So if India business comes back, FY15 could be a terrific year.
I don't know.
No, I'm just putting facts on the table.
I just get very worried because every time we use a word, it's going to be a better year, it's significantly better, or a terrific.
We are journalists. We have to look at your words.
Analysts translate into numbers. Then I get asked, what is the range? So at least for now, I would just leave the discussion with 2 or 3 commentaries. I feel good about where we are, and I have said that FY15 will be a better year and stronger year than FY14, and we will come ahead of NASSCOM. There was a specific question posed to me, and I said yes, and I would leave it there, and then let's see. And the year just began, and then let's see. We'll have an opportunity to meet again at the end of first quarter.
I'm now joined by on the show by Mr. Rajesh Gopinathan, CFO of TCS, Phiroz Vandrevala, Director, and Ojoy, who would tell us all the magical numbers he's been spinning around, how is he controlling those utilization rates. Gentlemen, good morning to all of you, and thank you for joining us. Phiroz, let me kickstart the discussion with you. Now, you can't find fault with these numbers. Impressive volume growth, margins at an all-time high. The problem is the following, that with TCS, expectations are always running high. Do you think you could have done better if the India hit was not there, and if US weather would have not hit you?
It's such an obvious statement. I mean, clearly with India remaining flat, and if you take a comparison of Q4 last year, we got a big kicker out of India. So if you factored in something like India having done as well as it had last year in terms of just Q1Q growth, obviously we would have had a better top line, no question. But the key is we've had a great year. We're confident about the next year. We think we have a healthy pipeline. All the conversations with our customers on discretionary spend are healthy. So we have a year to look forward to, and that I think is where we want to focus more than the year that's been.
Fair point. So, as journalists, we always tend to dissect your words, the management commentary with a microscope. Chandra clearly has outlined that FY15 will be a better year than FY14. Define that for me. You're giving me a very broad definition, it will be a better year. How do you define better?
I think it's largely based on growth. As far as margins are concerned, Rajesh will address that. But we've always had this 26-28% band. So we hope to stay in that band.
But when you say it will be a better year, what is fueling this optimism? Deal pipeline, environment, billing rates, everything.
Our environment, our conversation with our customers, all of those things.
Okay.
And the good news is we believe that the growth in FY15 will again be broad-based. It will be across geographies and across the vertical lines of businesses that we operate.
So I just want to hear it from you. Beating the NASSCOM guidance once again will be a cakewalk.
Nothing is a cakewalk. We never put it that way. But we remain optimistic that we can beat the industry guidance.
Okay. Rajesh, there's a marginal dip in margins. My understanding is that the currency headwind was not that high. Now, you lost because of dollar, but you gained because of cross currencies. So if the currency was not there, why are margins down?
It's a factor of realization. So you'll see the realization on a sequential basis is slightly down. And another factor is our ongoing investments in developing markets like Europe, where it comes with a bit of a different margin profile, especially in the beginning years. So not much to call out on, but it's a combination of realization and differential growth in different markets.
I was looking at your price trend, or the pricing trend rather. For 3 quarters there is uptick, for 3 quarters there is the downtick. So what's happening to the pricing regime? Is it stable?
Yeah. You pretty much said it, right? So for the last couple of years we've been saying that the pricing, overall the pricing scenario is fairly stable. What we report is realization, which tends to kind of fluctuate around a certain base. I don't see that changing in the near future. So we are in a stable pricing regime. Like you said, 3 quarters up, 3 quarters down. We'll kind of yo-yo around it.
You made a point at the press conference yesterday that you're not worried about the rupee-dollar equation. Now, there's a direct correlation in realization margins and the currency equation. So why are you not worried about the strength in rupee?
Like you said about journalists, reading it today, I realized that we are not saying that we will not get impacted. What you said is that we will get impacted and it will flow all the way down. From a business model perspective, we don't see the need to tweak the business model based on the currency. So our band of 26 to 28 was set on a certain assumptions on currency. That band continues. If the currency stabilizes at current levels or at different levels, and if we see an opportunity or the need to tweak the business model, then we will look at it. That's what I meant. It came out differently, I know. Okay.
So your margins are at 29%. Your guidance is 26 to 28%, which means margins in coming quarters will come down?
That's the way to look at it is this. You got to go back to where this came. Okay. So if you go back to Q2 of FY14, we had a very sharp depreciation of the rupee. And we maintained our constant currency margins, and the entire rupee gains flew down to the operating margin line. And we said we are not going to react to it immediately, but if it continues to remain at this kind of a level, we will calibrate our investments in certain market investments accordingly. So you've seen us doing that, 30-40 basis points every quarter. And if the rupee continues to remain weak, we will continue to invest more aggressively in these markets. So that's the intent.
So margins will come down then, if I read between lines.
Yeah.
Okay. The attrition rate would be in the range of about 11 to 12%?
See, attrition is also cyclical. For example, in Q1 and Q2, the attrition is going to go up.
Okay.
Because that is the time when people leave for higher studies. That is the time when we have completed our annual appraisals, when we have declared our increments and things like that. So that would induce some sort of an attrition at that point in time. It does. Each year it happens that way. And then Q3 and Q4 it again comes back. So overall, I think what we are very confident of is at this point in time, people are very charged up, people are highly motivated. So I don't see any reason why there should be sudden churn at this point in time. And we would definitely hope that we have all our people who are with us and they continue to be with us and they continue to grow with the organization.
I would say they're double motivated after the wage hike number you've shared. If I'm an insider, I would say great news. If I'm an analyst, I would say Impact on margins. Why is TCS being so aggressive? Which is my question.
Yeah. See, from an insider point of view, yes, people are definitely happy, and we looked at where we are. We looked at the kind of what people have delivered over the year and the kind of performance that the organization has done. And we have also looked at the overall market where we are at this point in time. So all these factors have come in. We have looked at the kind of growth that we foresee going forward, and based on that, we decided that it will be about 10% on an average in India. High performers will get higher. As I said, it is 14 plus. And in the in the developing markets, as I said, it is 2 to 4 and 4 to 6 in developing markets. So given that, there will be an impact on margins. As you see, it is on the Q1 when that impact comes in. And as we grow forward, it is the growth, it is the utilization, it is the kind of offshoring, and it is the kind of pyramid that we maintain. So all these levers that we have, and we are confident that we will be able to utilize these levers to again to operate at the kind of level that Rajesh mentioned, which is 26 to 28%.
He's pointing to you, which is my next prompt. What will happen to margins because of a wage hike? They will go down. They've gone down every year in Q1, but I'm trying to understand the quantum from you.
Quantum will be proportional to what it typically goes, so nothing very significant. See, we have done wage hikes on 1st of April every year, except 1 year in the financial crisis. So that's the cadence of the year, and no different this year. We have done well, rewarding employees, and that will have a proportionate impact. We are calibrating based on an expectation of growth. Together with growth and operational efficiency, we should be able to pull it back during the course of the year.
Understanding of FY15, do you expect growth is going to be uniform, or you could have a good start and a slow year? How are you mapping FY15?
India will be slow for the first 2 quarters. That's our belief. But I think we've hit the bottom. I don't think we'll go lower than where we are. If you look at our traditional model, clearly Q1 and Q2 tend to be stronger. In Q3 and Q4 you have the holidays and all the other issues that we've had year after year. But there won't be a major significant change. We look at our growth for the year, and clearly based on past experience, there is a likelihood that you will have a H1 top end. But let's wait and see how it goes.
Have you lost something significantly in US because of bad weather, and are you hoping that it will come back?
I don't think we have lost anything. It's just that a lot of the project work in US is on new technologies. And in the new technologies, one sector that is very prominent is retail, which embraces the new technologies. So there may have been the odd delay in starting up a project, but going forward, we don't see that having any impact.
The fact that Europe has done much better than US for the quarter gone by, is that some kind of an indication how things are progressing geography-wise, or that's just a one-off?
No, we certainly should see higher growth rates in Europe, because Europe has not even embraced fully the traditional outsourcing model. We're beginning to see that happen. So clearly, albeit of a low base, but our expectation would be is that Europe would continue to pump, because that's where a lot of the traction is. And that's a lot where our investment has gone in France. And we will certainly now focus also on Germany and some of the other markets that are big markets where we don't have a fair share.
Rajesh, your margin guidance of 26 to 28%. Now, it's a comforting factor when the going is bad, but some would argue when the going is good, why restrict yourself? Why restrict yourself at 28%? Because if new verticals, new geographies, areas like digitalization, they would kick in, then margins ideally should expand. Why is there a need for you to cap your margins?
The reason these kick in is because you invest in them. And when you have to invest in them, that's what you do with your margins. You take your margin, you invest in essentially fueling growth. So a lot of what we say is an integrated commentary. So growth is not going to come in and of itself. Digital is an area that we have been investing in. We continuously see the upside to be higher and higher, and it will pull in a lot of investment. Similarly, what you asked about Europe is coming because we have invested into those markets. Our growth in infrastructure services has come because we have aggressively invested into those. So the margin, we have a target margin band, and then we have an upside on that. We will calibrate our investment of that upside into this to drive business growth. That's the model.
Broadly, at percentage of your total receivables, how much they come in dollar and how much they come in other currencies?
We don't call that out.
So how do we judge how will the currency movement impact you?
We give you a fair amount of guidance in terms of how the currency movement impacts both the revenue line and as well as the margin line. We don't call it out on the receivable side.
So you're giving me a margin band. I should focus on that.
But in response to your question, we show you exactly how much of our revenue comes from the US, how much comes from continental Europe, how much comes from UK. I don't think many of our customers in continental Europe or UK pay us in US dollars. So it should be easy to sort of get a broad estimate.
Fair point. But Phiroz, last year rupee was at 55. Then it came to 68. Then now it is at 60. When you negotiate a contract with the client, how does the negotiation work? It doesn't work. They don't focus.
We have never used the current value of the rupee to negotiate a contract.
Okay.
There is a pricing model in the currencies. There is a whole evaluation process that finance goes through, especially on large bids, and it is not based on the current value of the rupee vis-a-vis the currency, but the currency itself.
So it's a myth when markets believe that, oh, rupee has appreciated, IT companies will take a hit, oh, dollar has appreciated, IT companies will hit a jackpot. That's a myth.
That's a function of operating in those currencies and what happens on the margin, as Rajesh was saying. But we don't take a call on our pricing based on the
I was actually looking for that answer. Ajay, utilization rate 83%, phenomenal. When we asked you last time, will you be able to sustain such utilization rates, you said yes, and the answer again is visible on the sheet. But 83% on such a large base, for how many quarters can you manage?
See, as the base increases, it becomes easier, because what happens is, for example, let's say it is 84%. That means I have 16% who are not on customer-driven projects. So they are in research, they are in my SG&A kind of thing, management. There are multiple other investments that Rajesh talks about. From people point of view, this is what we do. And now, as the base increases from 300,000, so 16% of 300,000 is a fairly large number of people. So as a result, utilization is driven by what other investments that you do, what is the kind of bench you carry is also part of that utilization, right? So as we go forward, we have said that we would like to maintain it at this level and we would like to improve it further.
Is it possible?
It is possible. It is possible. Yeah. And the other factor is, I think, what you should also look at utilization, including trainees. That we have improved by almost 5% as far as the last year is concerned, and that is a significant push in the utilization level. And as we go forward, our goal is to continue to keep our utilization level high, so that we are able to deliver the kind of margin that Rajesh has been talking about.
I was scanning through all the brokerage reports, and most of the brokerage reports are just flagging off one issue. It's not an issue, but it's a comment, which is that your guidance on total employee hiring for FY15 is very conservative.
Last year we started with about 45 to 50 in that range, and this time I have said we will be doing about 55 as the total gross addition, and that is something that we start with and we'll calibrate it as we go forward. Last year I think I increased that guidance twice during the year, and we have already done our campus hiring as far as this year is concerned, and at the same time we are going to push the utilization lever to a certain extent. So these are the reasons why we have set 55,000 as my target, and as we go forward we would definitely look at where we are, what's the kind of utilization that we are achieving, what kind of investments do we need to make, and these are the factors that would drive. If we have to hire more, we would be doing that. See, today I don't have to do all my campus hiring up front. In fact, even earlier days we used to do that. We used to do off-campus hiring at a later point in time, September, October time frame. Given the supply situation, I think it is better at this point in time. So it's not going to be a big constraint as far as we are concerned.
BFSI, that's the large bread and butter business for Indian IT companies. What's your outlook for the BFSI business?
Positive.
Positive. But obviously the base effect there would kick in versus other verticals.
We believe that vertical will continue to kick in and will deliver growth in line with the rest of the company.
Okay. Gentlemen, good luck. Thank you for joining us and have an excellent FY15 profit.
Thank you.
Thank you very much.